we will talk about investments that a company makes and then how they account for those investments. So these are our learning objectives. And again, companies are just like people. They can have excess cash that they maybe aren't going to use to invest back in the business itself. So they want to go ahead and invest in like either temporary investments to earn some additional income while they're maybe like planning a project or something like that. Or if they have no projects to plan, no expansions to do, they may actually invest it in long-term stocks. Now, so we'll talk about the reasons that they do that, because sometimes it's more than just to make some extra money. So we've got that cash again could be used inside the business to replace equipment, to make things more efficient, to expand their current operations. Maybe they're going to end up going into new geographic areas or get into new products. And then obviously it can be used to pay our day-to-day expenses and dividends to our stockholders and things that are, normal to the business. So if we have some excess cash, like, so say we think, okay, we've got 90 days that we don't need this cash. And in a big business, you could be talking $1 million or something like that. So it is not you don't just want to let it sit in your checking account. So they could invest in temporary debt securities, which would be bonds, or equity securities, which would be stocks of other companies. So again, not their company, but other companies. And then those will go into an investment section if they are short-term in nature, where we know it's only going to be for like 30 days, 90 days. It would go in the current asset section of our balance sheet. And again, that primary objective would just be to earn some money, receive some dividends, if we're buying and selling them, to realize some gains. So we're just trying to make a little bit of money in that short period of time that we have. Now then, let's say we have either excess money that we don't plan on expanding, or again, we don't plan on expanding for a few years. We may choose to invest that in something more longer term. Maybe if we are really talking about, hey, we want to acquire another company, that again is a way that we can do it by getting their shares of stock. So we could invest in debt investments. So debt investments are basically bonds. So we could purchase the bond. Then we'll receive interest revenue, semi-annually or however often the bonds are paid. Then we would sell them at the end, or again, if it was a shorter term bond, maybe we'd hold it to maturity. But then if we sold it, we could have a gain or a loss. So when we purchase the bond, we're going to debit an investment account for the purchase price, and that will include what we have to pay the broker in order to buy those bonds. Because again, just think it's in the open market. We got to get a broker to help us to do these transactions, so there will be commission involved. And then sometimes, again, there could be accrued interest, because if we buy them in between the semi-annual dates, there could be accrued interest included in that price. So here we have an $18,000 bond that has accrued interest for 45 days at 6%. And then this would be the journal entry we would use to record it. So we've got an investment in the bond, we've got those 45 days of interest receivable, and then we paid cash. And again, here they show you we're using our interest equals principal times rate times time. And then again, remember, the time is always ordinary or banker's interest, which is the 360 days. Then when we actually get paid, we're going to get paid that semi-annual interest payment. So that semi-annual interest payment, again, principal times rate times time, in this case it's a half because it's half of the year, we'll get $540. What you want to remember is we already have 135 of that set aside in the interest receivable, so that we're going to credit out, and then the remainder is going to go to interest revenue, but the cash comes in for the full amount. Then the next period we won't, we'll accrue it if it were at the end of the year and we're not going to get paid until the next year. Then we're going to set up our own interest receivable and record that interest revenue so that we're properly matching the revenue to the period that it was earned in. And that interest revenue goes in the other income part of our income statement. Then same thing, when they pay us, they'll pay us for the full semi-annual period. And again, it'll be split between how much do we already have set up in our interest receivable, and then how much is actually interest revenue. And then here it shows you a little timeline. Then if we sold the bonds prior to them becoming matured, there will be a sale price. We'll receive proceeds. It's more than likely going to be different than the book value. So if it's higher than the book value, we have a gain. If it's lower than the book value, we have a loss. So if we sell the treasury bonds at 98, so remember we had this back when we talked about issuing bonds, that is 98% of the face value. So it isn't $98, it's 98% of that face value. So then we calculate what that is, we compare them to what we have on our books, and in this case, we have a loss. So then we'd have to record that loss in our journal entry, cash comes in at that proceeds price, and then we take the investments off of our books by crediting those. And again, that goes in the other income section. Then we get into investments. So we, again, as a corporation, can invest in another company's stock. So we are the investor, and the company that we are investing in becomes the investee. And it all depends on how much of the stock that we buy to determine how we account for that investment. So again, we'll look at it from that level of what percentage and what degree of control do we have. So here's a nice little graph of it. If we own less than 20% of the shares outstanding of that investee company, we exercise no control, and we can use the cost method. If we go from 20 to 50%, we are exercising significant influence, and we're going to use the equity method of accounting. If it's more than 50%, we control that company, and we are going to consolidate them into our company. So our cost method, again, is when we don't exercise control, and it's just going to be, we're primarily investing just to earn the gains and the dividends that we can by playing in the stock market a little bit. So under the cost method, we're going to record the purchase of stock, the receipt of dividends, and the sale of stock basically at what happens. So if we purchase 2,000 shares at $49.90 plus a brokerage fee of $200, we calculate that out. So $49.90 times the 2,000 shares plus $200, we've got $100,000 invested in this Lisa company. So that's what we debit, the investment account, and then we credit cash. Then we receive a dividend. So the cash comes in, and then we record dividend revenue on that investment. And that again would go in our other income section of our income statement. Then maybe it's, a period of time later and we sell it. So if we sell it for more than our cost, we have a gain. If we sell it for less than our cost, we have a loss. So we sell 1,500 shares at $54.50 per share, less $160 commission, again, because we got to pay the broker. So we have proceeds from the sale of $81,590. So again, they show us down here the $54.50 times the 1,500 shares minus that broker fee gives us our proceeds. We compare that to the cost. What did we pay? So now we had more than that. We purchased more than the 1,500 shares, so we want to calculate out what was our price per share, and then multiply that by the 1,500 shares that we have. So that gives us the 75,000, and then we have a gain on the sale. So then we'll record it. Cash comes in at the proceeds. We take the investment out at the cost, and then we record a gain that again would go into the other income section of our income statement. Okay, then now we get into the equity method, because there's probably a reason that we want to acquire more and more of this company's share of stock. And normally it's so we can exercise significant influence. Maybe we're trying to get over the 50%, so we actually control them and we're kind of on our way. So we do account for these differently because the goal of them is different. It isn't just to make a short-term buck. It's to, again, acquire more and more control. So we use what's called the equity method. And under the equity method, we record our share. So if we own 40% of them, we record 40% of their net income into our income. So then when they pay us dividends, it's just like a return of that income. So then we take our 40% of their net income, put it into like an equity income type of an account, and then debit our investment account. Then when they pay us, it's like a return of that. So we credit the investment account and we debit cash. So here we purchase 40% for $350,000, goes into the investment account and we credit cash. Then when they show us, hey, here's our income statement, we had $105,000 for the year, we're going to record 40% of that as income on our books. So we debit the investment in that company's account, and then we credit this new income related to that equity investment for $42,000. Then when they pay us, the cash comes in, but then we take that credit out. Because if you think about it, go back to this slide, this represents 40% of their total income. They're not paying us that, but they're paying us a piece of it. So now we're going to receive it and then take it out of where we put it. We hung it up in the investment account. Now we got to take it out of the investment account when they give it to us. So again, here's a little slide that shows that, kind of in images. Okay, then what if we sell it though? So again, like I was saying, there's probably a reason we're holding it, but maybe that reason changes and we no longer want to hold that much stock of this company. So we will have a gain or a loss recorded, and we'll compare again the proceeds that we sell it for to our book value. So now if we sold the stock for $400,000 and we go to the book value, we go to our general ledger and say, what did we have in that account for that stock investment? And then it's $374,000. We have a gain of $26,000, and we'll record that gain because it really happened. And then it too would go into the other income. Now then, what if we get to the point where we are trying to actually buy this company? We want to own it. We want to control it. If we get over 50% of the outstanding stock, we now control it. So then that is going to consolidate into our business. So a lot of our big businesses that we think about in our environment right now, like Pepsi and General Mills, and I mean you could go down the list. They even like Smucker's, so even local companies have grown through business combination. So they buy a company that's up for sale, or they buy more than 50% of the stock, and then now they combine it into theirs. So again, they could do it to expand into new geographics, to get into new product lines, maybe maybe the other company has some patents and things that can help them produce more efficiently and have a better operation. So there's a variety of reasons that companies do it, but they do it all the time. So then now what we have is a parent company and a subsidiary company. So the parent company is what we call the investor, and then the subsidiary company is what we call the investee. And then they're going to prepare consolidated financial statements. So then that is almost a whole different topic, an advanced accounting type of a topic. So then how we value our investments, again, we go down to say, okay, they're bought and sold in the New York Stock Exchange, so their market value changes every single day. So we're going to use generally accepted accounting principles to value our debt and equity securities, again, when we're down below that 20% ownership. And at that level, we should always record them at our fair market value. So again, that trading security could be bonds or stock, debt or equity, and they're bought and sold in the open market. So that's what we're kind of talking about with these trading securities. And we're going to record them at their fair value. So again, so what we'll have, if you think about it, like think about your own 401k or whatever, if you look at that statement, it will show you unrealized gains or losses. So you haven't sold it yet. There is no realized gain or loss. You're holding it. But so when you get your statement, you say, hey, the market value's gone up, I've got an unrealized gain. Market value goes down, I have an unrealized loss. So then they group them together, say, okay, these are all of my investments, my total cost, my total fair value. So I have an unrealized gain. So I'm going to record that. Sorry about this. Hold on. Okay. So you're gonna see that we record that unrealized gain in our trading investment, and then we have a valuation allowance that we create. Now that unrealized gain is going to be reported separately in the other income section of our income statement because again, it's not a true realized gain. And then our valuation allowance account is going to be shown in our balance sheet, and we would add that to the value of our trading securities or investments. Then it can go the other direction though. If the stock market goes down, we can have an unrealized loss, and then it would be then we would deduct it. So again, it could go either direction. And then over time, again, there'll be pluses and minuses going into those, adjusting them as again to bring them to the fair value. Available for sale securities are ones that we could sell today if we chose to, so we're not holding them for any strategic reasons. So for those ones, we'll report it as part of our stockholders' equity section. So here we have our total cost and our total fair value. So we have an unrealized gain. So it will go into that valuation allowance and then our unrealized gain, but then it's not going to be on our income statement. It's going to be in our equity section of our balance sheet. So here they show you that. So down in the stockholders' equity, unrealized gain on available for sale investments. And then the allowance, though, is still pretty much handled the same, except for, again, now it's in our current section, not our long-term section, because, again, they're available for sale, meaning we could buy them or sell them at any point in time. Okay. And then, again, could go into the loss or the gain, could go either direction. And, again, over time, things are going in and out of there, so we're going to see those change. Now, held to maturity, the company has to have the ability and the intention to hold that investment to the maturity date. So say it's like a bond and it's going to go out 10 years. They have to have the ability and the intention to do it in order to classify it as a held to maturity. So notice what it says here, equity securities are not held to maturity because they don't have a maturity date. So it's really only primarily bonds. I mean, it could be a note, but bonds are much more common to invest in. And so if it's a held to maturity security, it's going to be recorded at cost. And again, it's a bond, so we could be paying a premium or a discount when we go to purchase it, again, depending on what is happening in the market. And then they're going to be recorded on our balance sheet at that amortized cost. So here gives you a nice little summary of how we account for it and where they end up on our either our income statement or our balance sheet. So this is a nice little slide to refer back to when you have questions on that, because again, it can get a little bit confusing. And then here shows us again the balance sheet that we've got trading investments, we've got the valuation allowances, we have a long-term investment that is being accounted for at the equity method. So then we don't have any allowances on that when we do the equity method. And then over to our income statement, in our other revenue and expense, we have unrealized gain. And then we have that equity income on that investee company that, again, we don't control them, but we have significant influence over them. So we record our percentage of their income in this equity income account. And then fair value accounting. So again, the fair value is what the price we would receive if we sold that asset under normal conditions. And then when we follow our generally accepted accounting principles, our available for sale investments need to be recorded at fair value. And then we'll use that again, those will go into our balance sheet and into our income statement. And then any changes in that fair value for those available for sale, remember back a few slides, those go into our stockholders' equity, not directly into our income statement. And then our trading securities, those are the ones that we report at fair value, and our unrealized gains or losses go into the income statement. So again, just kind of rehashing what we've already talked about. Then we always end the chapter with a ratio. So we have our dividend yield. So our dividends per share divided by our market price per share will give us a percentage, how much we are earning on that investment. Again, that's their it's their ability really to pay, because it does talk a little bit about profitability, but companies can be profitable and choose not to pay a dividend. So again, as they get older and there's less room for them to reinvest that money and grow, then they will start to pay out dividends. So it's really a measure of both. Do they have profit and do they have the ability to pay? And here shows you some dividend yields from different companies. And you can kind of see that percentage. And again, most of the companies that do pay out dividends are older and have already kind of grown to their full potential. And then comprehensive income is a definitely more advanced accounting type of a topic, because so it's what's going into that equity section of our balance sheet. And we'll call it other comprehensive income. So in this area, we talked about those available for sale securities, but then there's also more advanced accounting topics such as foreign currency translation adjustments and pension liabilities. Those can also go into that other comprehensive income. So again, a little bit more of a higher level accounting topic, but this is just showing you what we talked about in this chapter and how it does go into that. That is it for this chapter.